Okay, let me keep it real with you. You've probably given the IRS thousands of dollars for free without even realizing what you're doing. See, if you're a small business owner and you don't have your business structured properly, you're leaving thousands of dollars on the table, just giving it straight to the IRS every single year with no questions asked. And that is not your fault. That's because nobody taught you how to properly set up your LLC, make the right motions to pay yourself, and calculate the proper deductions. My name is Darren Belizaire. I'm a real estate agent here in the state of Florida, and I'm also a tax prep agent. So I've helped thousands of people just like you every single year get their finances in order for their small businesses so that they can purchase a home or move on and do something proper with their business. Before we jump into solutions, we have to address the problem because once you see it, you'll never unsee it. You're probably paying too much money to the IRS because self-employment tax is crushing you. What is self-employment tax? Self-employment tax is a 15.3% tax that is taken from your net income of your business if you're a sole proprietorship or just an LLC. That is the taxes that carry for your Medicaid, Medicare, Social Security benefits, and that is taxed at 15.3% of your net income. If you were to work as a W-2 employee for a company, your boss will be paying half of that for you while you pay for the other half on your paycheck. But as a small business owner, you're responsible for that full amount, right? That 15.3% comes straight from your money. So if you were to make $100,000 in a year, you'd be paying $15,300 to the IRS for the self-employment tax and your contribution to Social Security and Medicare. Now, if you want to add on top of that, your income taxes, you understand how quickly it goes up and why it is so expensive and why at the end of the year when it comes to paying your taxes you have no money left over. Now here is where we flip the script. There's a structure, a tax structure that's going to help you save money every single year because you're a small business that allows you to pay yourself in a better format so that you can keep more money into your pocket, pay the IRS less, and invest more into your business. The structure that I'm talking about is called an S-Corp. What is an S-Corp? An S-Corp is not a new strategy. No, it is simply a tax filing status telling the IRS that you want to pay yourself as an S-Corp. That means you'll be taking a distribution and a standard salary from your business. While the salary is taxed with self-employment tax, the standard distribution is taxed normally, right? You'll be paying your federal and state income taxes on that income. Now that we understood the concept, let's talk numbers, right? How does taking a distribution versus taking a standard salary really helps us really put money in our pocket and save in the long run? What is a standard salary? A standard salary is what you'll pay somebody in the same industry that has a salary to do the job, right? Someone that has the exact same responsibilities as you in a business, someone that is maybe the CEO, manager, or whatever they're doing, right? Let's say you are a photographer and your business made $140,000 last year and you pay yourself a standard salary of $60,000 because every other photographer that you know in the area makes about $60,000 a year. That is the standard salary. That is what will be taxed with the self-employment tax. The rest of the money left over, that $80,000, now becomes your distribution, and that distribution is only taxed at a federal and state income level. So what does that look like in numbers? Well, let's say you did not take that distribution, you did not set up the S corp, right? And that business made $140,000 a year. Then you take that 15.3%, multiply it across, you'd be owing the IRS directly about $21,000 more or less on your taxes right away. But if you were to set up yourself as an S corp and you paying yourself a salary of $6,000, now you only owe the IRS about $7,000, and the $80,000 left over, you'd owe the IRS about whatever your state taxes is. So in the long run, that'd be a saving of almost $12,000 right into your pocket that you can put back into your business and function as you need to, right? That strategy is very simple, very basic, but this is what millionaires and proper business owners do to pay themselves every single year so that they don't have any trouble at the end of the year. They can use that money to leverage a loan into their business, leverage a loan into their personal life, or scale and grow their business. Listen, every dollar saved as a business owner goes a long way. We've covered how it works, we've covered most of it. Let's talk about how most people make mistakes and what can get you caught up with the IRS if you do not use that technique properly. As a small business, too many people tend to want to underpay themselves when taking that distribution so they can lower the self-employment tax, right? They want to lower that amount so that the IRS thinks that they didn't make a lot of money this year. They're just a regular person, right? But this is what causes red flags. See, the IRS looks at your business, the type of business that you owe, look across the nation or across your area as to what the average person makes in that business. If they've been in business for a long time, what are the costs of starting? And they will look at that. That will raise red flags. You also don't want to overpay yourself, because if you're overpaying yourself, you're no longer really benefiting from being an S Corp. At this point, just go ahead and be an LLC, since you want to give the IRS so much money anyways. A good rule of thumb is to pay yourself 1/3 of the net profit of your business. So if you made $90,000 in your business for that year, you want to pay yourself $30,000 salary, and that way you have a good standard salary to go off from. And don't forget about the Medicare and Social Security taxes. If you want to make sure that you're doing it right, get yourself an app like Gusto, ADP, or even QuickBooks. These will allow you to pay yourself better and put yourself in a better position with the IRS. With those applications there, that means you're taking yourself on a payroll. You're putting yourself on a payroll for your company and taking out the proper amounts of taxes as you go. So that way, there's no miscalculations. You're not doing the math yourself. The math is being done for you. That was a lot of information, right? But now you're probably asking yourself, how do I pay myself? I just told you, you have to do a payroll. So set up a payroll system, pay your Medicare, Social Security taxes, pay yourself like you would an employee. Think of your business and yourself as two separate entities, and you as the owner or an employee of the business paying yourself as a W-2. So you're taking out all the appropriate taxes and giving yourself a runway to work from. Now, when you want to take the distributions, you can take those directly from your bank account, right? You want to send this from your business account to your personal account. That is how you keep track of your deductions. Now, remember, your distributions are still being taxed, right, at the federal and state level, just not that 15.3% that we talked about on the self-employment tax. That way, you're saving money, you're still paying your contributions to the IRS, and you keep yourself out of trouble. When taking your distribution, do it as needed. If you need to take them monthly or quarterly, take them monthly or quarterly. If you need to take them weekly, take them weekly, right? If you have to pay bills using that, go ahead and do that for yourself. Is an S Corp right for you? Here's a quick checklist. Are you netting over $50,000 a year? Are you ready to run payroll? Do you want to qualify for funding for or mortgage? Do you want to stop overpaying for taxes? If you said yes to any of these things, you are ready to take an S Corp. Now, let me give you the blueprint. Here's how you can start your LLC and make it into S Corp right away. Step one is to form your LLC. File your local, state level documentation for your LLC, and two, apply for your EIN. Once you've applied for your EIN, you want to file for the form 2553 with the IRS. That is your designation form. You want to set up a payroll account with a company like QuickBooks or Gusto to handle your payroll, and every single year that your business is in order, you want to file a 1120S. That is your S election file, reminding the IRS every single year that you are in compliance and you are a 1120S business, an S Corp. Listen, every state has their own rules, so make sure to follow up with your local or state, with your local and state level. Make sure to follow up with your local and state level bureaus to know exactly what to do. And if you need more help with that, DM me now or send me a message down below or comment down below, and I will assist you to file your taxes and as well do your S selection every single year. Listen, this is bigger than just taxes. We're talking about saving your business thousands of dollars every single year and putting yourself in a better position for your business and for yourself. Having an S selection versus an Having an S selection versus just a standard LLC allows you to get access to business funding a lot sooner than if you're an LLC, and also allows you to distribute your money a lot better. So if you want to retain more money into the business, you can do that. And if you want to pay yourself a higher salary or the regular standard salary for your business, you can do that. That way, your money does not get lost in translation and you know exactly where you stand every single year with the IRS. My name is Darren Belizaire. Again, this has been a short video telling you how to file for your S Corp. And if you need more help, feel free to message me.